So the housing market remains in some trouble, but we're going to take a look at a housing stock of sorts today on Open Interest and take your questions. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Just one quick point, because I'm going to be on Fast Money today, and that starts at 5 p.m. Eastern Time. This is going to have to be an abbreviated session, so if you have any questions, be sure to put them in now so that we can get right to them. And because of that, we're not going to have a really lengthy intro, but this was something I happened to be looking at over the weekend. What I was doing, and we can share my screen. I'll pull over what I've got over here, and we'll pull this in. What I was looking for were stocks that have very high implied volatility and are well within their 52-week highs and lows going into earnings and don't have a lot of leverage on the balance sheet, where I can imagine some reasons why there would be a measure of support for the stocks and where I thought there might potentially be some headwinds, other than, of course, the 52-week high, which presumably is going to create some resistance in any case. Out of the Russell 1000, this was a shortened list that I came up with. Some of these stocks clearly do have a lot of leverage, like Carvana, which is up here at the top. I'm just going to blow this up a little bit because we're not going to really look at this too much. But, you know, Carvana, then we've got names that are in the crypto space, which are understandably quite volatile. But it was Zillow that kind of caught my eye here. And the reason Zillow was interesting to me was because Zillow doesn't actually have a lot of leverage on the balance sheet. In fact, it doesn't really have any. It actually has net cash of about $800 million. The other thing that's kind of interesting about Zillow is that, of course, because it's associated with the housing market, and the housing market continues to have some duress, a function of lack of housing affordability, short supply, the fact that many people are locked into their homes by very low mortgage rates. They have a couple different verticals within their business, but it suggests that sort of a real big expansion at this point is kind of unlikely. But the other thing that's kind of important here is that several years ago, some of you may remember that the company decided that they were going to expand into real estate speculation. And in fact, they started buying some single-family houses. By mid-2021, I think, or mid-late 2021, they had acquired 7,000 homes. And that didn't turn out so hot. If you're looking at my screens, you can see over here, I'm going to blow this up a little bit so we can get a good look at it. And I know you can't see my cursor, but I'm going to hover over a number that's kind of important over here so you can see that little block that's showing up here. That was a loss of $430 million that they took in full year 2021. If you fast forward to the expected adjusted net income for full year 2025, $411 million, what is going on here is that, you know, the company did round the bend in the most recently reported quarter. And the expectation for the quarter that they are about to report is that they're actually going to report net income in the neighborhood of 105 plus million in net income on adjusted EBITDA. Of the street consensus here, I'm going to hover over that number, is 157.4, $157 million. This, by the way, is mostly just a function of the company's own guidance. So the company in August guided to $150 to $160 million worth of EBITDA. And, you know, at this point, this doesn't make the company cheap. Even if they were to achieve this, it's trading at over 30 times next year's anticipated full year earnings. And those earnings, if we're just going to go to this, okay, so $2.16 a share, so over 30 times. But this is 32.84% year-on-year anticipated growth, so a PEG ratio fairly close to 1. Not all of that is coming from organic growth. Some of that is also coming from the company's buyback. They have an open market buyback plan in place. They have over $1 billion remaining, which is about 5.7% of the current market capitalization of the business. And then if we just take a look at a chart over the course of the last year, we can see that it is almost smack dab in the middle of its 52-week trading range. And we can combine that with the fact that it has quite a high implied volatility. Arguably justifiably, it's had some fairly big moves on earnings, but the 3-month implied volatility is north of 50. And what that gets us is an opportunity to sell some premium on this thing at levels that essentially make the break-evens the 52-week high and low. So let's illustrate that really quickly. So if I go out to December, I was just looking at 60-day strangles. So we'll just put this in here. So if I'm looking at a 60-day strangle going out here and I say, okay, well, I want to sell the 80 calls, I want to sell the 60 puts. This is a little bit less than it was before, but you know the mid-market price on that's about $4.90 a share. We'll call it. Stock's a little higher today than it was when I was looking at that over the weekend. So that gets us to a standstill rate of return of 6.86%. And it means that the upside break even on that trade is going to be 80 plus the premium collected, or 84.91, or it's going to be the put strike less the premium collected, which is below 56 bucks a share. It's actually almost 55, which, as I just pointed out, are effectively the highs and lows for the stock. So, you know, 86.76, that's where the stock was back in September. You know, it's within spitting distance, a couple percentage points of the upside break even, and 56 bucks is the downside break even. So I'm using this both to illustrate a way to think about things and also what I think is arguably a reasonable opportunity. Now, I also want to point out that a year ago, when they reported, when you take a look at this low that they had, that was in November of 2024. And in very short order, the stock rocketed substantially higher, got up to, what do we have here, $82 on, you know, basically, this is a company that has not been profitable for years, not meaningfully profitable in any case. And, you know, there was this hope and expectation that they were finally rounding the corner. That seems to be baked into the cake now as well. But my point is that I do expect that the stock, even if you do get better than expected numbers, and right now the numbers that are expected are better than the company has ever reported for any quarter since it's been publicly traded. So putting these things together, you know, solid balance sheet, buyback, looks like they're turning the corner. That should create some measure of support. Plus, you can assume that there might be some support at the prior lows and resistance by the prior highs, and just the fact that the housing market is a little bit distressed and the multiple is not terribly cheap. It's not unreasonably expensive, but it is safe to say that, or reasonable to say, I don't know what's safe, but it's reasonable to say that I think this is one of those cases where we're looking for a situation where we have identified clear entry and exit points, getting long the stock at its 52-week lows, getting short the stock at its 52-week highs, and a reasonable case could be made for either of those two things taking place. So just a way to think about things. Like I said, there are other stocks where this is the case. You know, make of that what you will. But I also saw that there were some pretty good questions here, so I figured we'd just get right into it because I have only a limited amount of time today. So Ranjana asks us, "Hi Mike, I bought Schlumberger at $41.50. It's down considerably. Please provide your outlook for the oil services industry and SLOB in particular." That, by the way, Schlumberger, that's what we often called it on the floor. We were specialists in Schlumberger and Halliburton. In fact, oil service index was one of the first things I traded back in the late 90s. Is my only option, pun not intended, to write covered calls? Well, that's not your only option, to be sure, but it certainly is one. If you're looking to lower your basis or just get a little out of it. Needless to say, one of the things that is hurting it here is that, you know, we've seen a lot of commodity prices go sharply higher, but not oil so much, right? So Gold has hit all-time highs. This is where we're at with crude right now. So you can see that, here we are with West Texas, below $60 a barrel, and that's just not that compelling. Now, Schlumberger, when we think about the two oil service companies that I think of most often, Schlumberger is the most notable, the largest. Halliburton in second place. Halliburton has more onshore exposure, North American exposure, than Schlumberger does. But this is just not the market where you're going to start seeing really significant investment in the space. And, of course, that's what's going to fuel their respective businesses. But if we're going to take a look at valuation, which, of course, we should, let's see where we're at. So we're at 11.4 times estimated forward earnings, which is below the group, although it's a small group is listed here. They only have Baker Hughes and Halliburton in there, and below its own historical average. Things are always darkest before the dawn. I probably wouldn't be a seller of it here. Let's take a look at what the technicals have for us, and then we'll take a look at how the buy rates look. So, I mean, based on this, most of the better performing technical indicators actually are reasonably positive. And in terms of volatility, the one that we care about is the white line. Are options expensive or cheap relative to their own history and relative to the stock's actual behavior? They look to be slightly above the one-year average, other than this one little blip here, and above how volatile the stock has been. So that suggests that selling covered calls may be attractive. I'm going to shorten this up because we don't usually sell them as far out as 3 months. Let's see what we have here. So 33 and change for the 2-month. And about the same here. Earnings are coming up on... Oh, we already had earnings, so that's taken care of. Yeah, so I think let's take a look at what I'm getting someone in my ear. They probably have a suggestion, so I'm happy to hear what that will be. Yep, I'm being told keep it up. So I'm gonna try to do this very quickly. So we're just going to assume that you are long the stock, sell a call. I recommend going out, probably 45 days ish. You could go out to as far as December. November is probably a decent choice. And I would, you're going to be looking to collect at least 1% on a monthly basis. So in order to accomplish that, this has got 39 days to go, so you're going to want to get about 50 cents at least. Or maybe a little bit more, but that would get you into this situation right here, maybe selling the 36s. I'm just going to go back to that first chart very quickly, see where 36 would be. Which is right at the 200-day. There you go. So that might be a decent way to play this. Sell a call at approximately the 200-day moving average, getting over 1% per month on a standstill basis, and no immediate catalyst between now and expiration. Okay, FinWest. Good morning, Mike. Happy Monday. Would you explain flex options, how they work versus regular options, and does YieldMax use them in any of their products? The short version of this is yes. I have made markets in flex options. I have used them fairly extensively. I actually used them in the aforementioned American Airlines US Air deal, which was going to provide, so I was trading flexes on US Air as a mechanism to hedge a long AMR position when they were operating in bankruptcy, when they were going to create NewCo. So what is a flex? A flex is a flexible exchange-traded option. I believe that's what the acronym stands for. What is it? It is an option that is bespoke. You may choose the expiration. You may choose the strike. You may choose whether it is American or European, and you may choose the settlement. Is it physical, which in the case of a stock option would be the underlying stock, or cash? For YieldMax, we absolutely do use them. What we do is we, especially with the covered call ETFs, we use synthetics, or what are sometimes called combos, long call, short put. Because there are concentration rules within registered investment companies, what we will do when we create that combo is we will typically sell a flex put that is European, cash settled, usually a penny above the strike of the call that we buy. So let's just say the underlying stock, let's say it was Schlumberger. Okay, so what we might do is sell a 3-month 33.5 or 33.51 strike put and buy a 33.50 exchange traded call. Now, on the call side, we don't need it to be European, and we don't really care if it's cash settled or not because we own the option. So exercising the option is up to us, and so we can control that. On the short side, we like the flexes because that's something that happens to us. It's not something that we elect. So in that case, a flex is very helpful. Why would one trade a flex versus an OTC option? So basically, flexes are the listed options world answer to OTC options. The simple answer is that they're exchange traded. They are fungible, meaning that I can enter it with one market maker and exit with another, and my counterparty is the OCC, the Options Clearing Corporation, which is the counterparty for every exchange-listed options trade. And that's, well, it may or may not be important. For some institutional investors, they might not like the fact that flexes will show up. You can see that they're out there, whereas an OTC option may not. But in general, this is a better place to be if you are a counterparty from a risk perspective, because the OCC is as strong as its strongest member. Whereas if I trade an OTC option, a bilateral agreement just between me and some bank, then I am relying on the full faith and credit of that bank to satisfy their obligations in the event that they are called upon to do so. Normally that's not important, but if you were into any OTC derivatives with Lehman Brothers, you found out that indeed it can be important. So flex options are basically bespoke options, but they are exchange traded and OCC cleared. And the principal reason to do this is so that you can choose your strike, choose the type of option, American or European. American options, for those that don't know, means that you can exercise the option at any point up to its expiration date, whereas a European option can only be exercised on its expiration date, and you can choose the nature of the underlying. Is it cash settled, or does it settle to the underlying? And so, yes, we do use them. I have used them in other contexts. Haven't traded them as much as listed options. That's not surprising, but I've traded them a lot. And, you know, this is not something that most people really need to concern themselves with unless you have something very specific that you're trying to hedge that precludes using American-style options in particular, or if there is a potential settlement issue. The cash settlement aspect is particularly appealing. Where would that have come in handy? Could it come in handy if you were trading, for example, Silicon Valley Bank? I'm trying to remember one of those banks. It was either Signature New York or Silicon. One of those banks, when it failed, a lot of people had bought puts because the stocks had rolled over and their distress was well known. But not everybody who bought puts actually ended up profiting. I actually spoke to some investors who had bought puts on those banks. The banks rolled over. Then the stock stopped trading. And they weren't able to exercise their puts. They could not exercise their puts because they couldn't get a locate on the shares. So if you're going to exercise a put, you're basically exercising your right to sell the stock at the strike price. Well, you have to have the stock to sell it, or you have to have a locate, a borrow on the shares in order to sell it. If that had been a cash settled option such that it was just going to be versus the previous price, that would have been a much more favorable characteristic. SPX options are cash settled, and they are European. And I like it that way because then you can set, forget, come expiration, you don't have to worry about anything surprising happening after hours and taking assignment. or suddenly realizing that you need to exercise your option. They just settle to the cash value of the strike versus the settlement price, and you're done. So I hope that is, yeah. So you were saying from what I know, one can define your own strike, expiration, and settlement method. Yes, but then who's willing to take the other side? It doesn't. They price on vol. So, from my perspective, when I was making markets in these things, I didn't really take a whole lot more edge in those than I would for any other option. There's, one of the nice things about it is that from a market maker's perspective is that once upon a time, options were what we call single listed. That meant that they all traded on a single exchange, and all of the market makers on that exchange were the ones that made markets. So Dell was single listed on the PHLX, Intel was single listed on the Amex, Microsoft, I believe, was single listed on the P-Coast, IBM single listed on the CBOE, and so on. Now, one could argue, well, doesn't that create an unfair situation where you have one exchange and the market participants on that exchange, rather than everybody competing to make an aggressive price? That's true, but you can make a more aggressive price if you know that when the other side to your trade is going to unwind it, that they're likely to come to you. If I trade a flex in good size, it's a decent chance that I'll be able to make as competitive a price as anybody when it comes time to unwind it. So in a curious way, it seems like it's less liquid because it's off the run. It's not a conventional listed option. But actually, you're probably going to make the most competitive price on the back end. So you're probably going to get a chance to get out of it. I don't really consider it a huge risk from a market making perspective. And frankly, if it's European option, that's in some ways simpler to price. If it's cash settled, it might be simpler to price. If I'm selling a put as a market maker and it's cash settled, that might be a little bit cleaner as well. So sort of cuts both ways. Is it going to be a little harder to trade? A little. A lot harder? No, not really. Okay. I would like to, Monday morning quarterback, I would like to sell calls against Netflix into earnings. Your thoughts on strikes and dates? Yeah, so let's take a look. Let's see what we have here. So, I wouldn't feel bad about selling it at these prior highs, even though that's relatively close. I don't think the moves have been, let's see what we've got here. You may want to tune in for fast, by the way. I think we're going to be talking about Netflix today. Have somebody who's in the space who's going to be talking about it. Implied move, slightly smaller than average, so the options aren't super, super rich going into it, but I do expect that probably is going to run into some resistance, so we'll go like this. Probably going to be looking at a very similar expiration, 39-ish days. Probably look to do something in the, let's see what we got here. What did I identify as that? What was that prior high? 13. Well, 1350 is on the outside of it, and you can look at it from a perspective of that plus the premium you collect. But yeah, I mean, something like this, 2%, almost 2%, standstill rate of return at the prior high, good likelihood that you collect it. So yeah, trying to punch right through these, but I hope that helps. Monday morning quarterback from Japan on holiday, 5 a.m. here, and typos from my phone. Well, safe travels and enjoy that. I actually was just saw a note that someone said it was a good place to buy a watch, particularly I would assume if you happen to like Japanese watches. And there are some that I think are pretty nice. Some of those Grand Seikos look very nice and like a very good value, even if you didn't get a great deal on them. So enjoy your travels there. I've heard great things. I have not been myself. Alex V659. Hello, Mike. Hello to you, Alex. Palantir, you like it for the long term. Thinking of buying a 185-220 call vertical and selling a Nov 7th weekly 210 call against it to take advantage of the elevated vol. Well, let's see how elevated and why it's elevated. First things first. So it is elevated because of the earnings. Earnings implying an 11.4% move, which is much less than the moves over the long term, although the most recent one was 7.85%. So if we're expecting that the moves are kind of coming down in terms of their magnitude, which is reasonable, that is a common thing. And on top of that, look, I mean, we saw over the course of the last couple of weeks that there is some anxiety here. People are seemingly ready to evacuate from some risk assets. So let's take a look. And also let's take a look at our highs here. 187.5. We'll go through the same exercise. And we're going to, make sure I get the right ticker in here. So I'm going to just quickly construct the trade that you have. So the Jan 185-220. And then you were looking to sell a weekly Nov 7th 210. Oh, okay. Now that I think about it. So actually, that's going to come up with a structure that looks a bit like that. Yeah, I mean, that does work. Let's see. Let's take a look at this implied move. 181.6. 200. Yeah, so the call you're selling is outside the implied move. Let's get back and just take a look at some of... I mean, I actually think that is a safe trade, but you would be potentially short the stock. And I think we should take a quick peek at what the worst case would be. And by that, I'm just going to say, okay, well, what was the biggest move that this thing has taken post-earnings, and where would that take us? So there's 24%. There's 30. I mean, I really am not expecting that. It's a much more mature situation than it was. But 181.5-ish. So that's 236. That was the kind of move that we saw some time ago. Again, I don't anticipate that. But at 236, your break even's going to be down about $1,000 every time you do that. I think it's very low likelihood that happens. It does create a standstill rate of return. So yeah, I think that's fine. It's sort of a variation of some of the other trades we've looked at, but sure. Okay. Also Monday morning quarterback. Hi, Mike. For directional earnings play, people like calendars and diagonals, but what about a risk reversal? Example, Intel bearish, buy an at-the-money put spread, sell a call spread at the expected move. Yeah, this is interesting. I mean, I'm kind of two minds where Intel is concerned. They clearly have not solved their problems with respect to how their products are positioned in the marketplace. But now they've got the government's investment. They've solicited some investment from other parties. Maybe that creates some short-term stability. But let's just build out a trade the way you're talking about it. And actually, were you saying, out of curiosity, we're using, ooh, I'm already at 145. Okay, so running out of time already. I apologize for keeping it so short today, but I don't normally have fast on Mondays, but I do today. So let's just quickly build this out. You have an at-the-money put spread. You didn't specify what expiration, but let's just go to weeklies. Why not? Buy an at-the-money. Maybe we'll sell I've got to switch this to a put. Sell something like a 20-ish delta put. Why not? Or we'll choose this one here. And selling an upside call spread, I guess is what you were thinking. The interesting thing about this is that depending on how much skew there is, selling call spreads and buying put spreads are both oftentimes taking advantage of that skew dynamic. So I don't know what strike. We'll just pick something like that. Let's see here. Selling 247, maybe go a little higher up. Buy. You end up with something that's sort of step stair looking thing like this. I think that's fine. I would probably be personally more inclined if I was expecting a short-term move to simply sell the upside call and buy the put spread rather than selling the call spread, because you're really stitching two put spreads together. But that, that's going to be a margin, a capital, and a risk constraint thing to think about. What I mean by that is, sometimes you can't do this for margin reasons because you're taking the risk that you could be short the stock. But I would probably be more inclined to trade it like this. I might also do a ratio on the downside. So it depends how many times you're going to do it. So if you're going to do a one lot, get short $4,000, $4,200 worth of the stock, up a few bucks. You might, buy one, sell two puts. But if you're going to do more than a one lot, then you can do sort of off ratios. Like, so for you, sell two, buy two puts, sell three further out of the money puts, and go like that to try to capture some of the post-event bull crush. All right. Thoughts on gold, several short calls versus stock, summer 1031, 355 roller, let it get called away. Does feel like gold, if you're going to let yourself get called away, there may be a tax consequence. And you might actually have a better tax consequence. We're coming in towards the end of the year. So think about this for a second. Let's say you own GLD. Let's say that you bought it in January. Up a lot. I'm going to just put this in so we actually have it on the chart here. So you bought it at the beginning of the year, and the stock's up a ton, right? So congratulations. You sell an upside call. Let's say that you sold that call, and you were saying the 355s. So these are slightly in the money. So what happens? If you just allow your stock to get called away and you owned it from a much lower price, and if you owned it for less than a year, what's going to happen is you're going to have a short-term capital gain, not providing any tax advice, just giving you guys something to think about. It is something that we deal with. How and when do you realize your gains? If you get called away, you are now going to have a short-term gain. So that could have tax consequences for full year 2025. On the other hand, if you cover that call, assuming you have the cash available to do so, you do not have a realized short-term gain. You actually have a realized short-term loss. So the question I would ask people when you find yourself in this situation is, look at your overall realized capital and gains for the relevant tax period before you make that determination. This is not simply about how the price of the underlying behaves, because there could be real economic consequences to going one way or the other. If you have realized losses and you can take those gains against those, it's your CPA. Okay. All right. So that's no real tax consequences for your IRA. So good point. But this is just something that I want people to think about. My attitude about it would be, I become a seller of gold when gold begins to roll over, and it has not yet done that. And I unfortunately have only this amount of time to give you guys today. I'm sorry for that, but please be sure to tune in tomorrow for office hours, and on Wednesday at 4:15 for another version of Open Mic. Like, subscribe, and come back for hopefully a longer version. Thanks very much for watching.